Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about bullish and bearish gaps, two powerful price patterns that can signal major market opportunities. These gaps often reveal hidden momentum in the market and can set a stage for profitable trades when understood and used correctly. Stay with me until the end of this video as I will not only explain these levels of this gap, but I would also show you step by step how to trade them effectively to maximize your returns. So let's get started. First of all, we have to start by understanding what a bullish and a bearish gap is. Gaps are price areas on the chart where no trading activity occurred, creating a visible empty space between one candlestick to the next candle open. That's between this candle close here to the next candle open. This gap often form due to significant market events such as economical news or changes in market sentiment, and they can provide valuable clues about potential price direction. Now, the bullish gap occurs when price or when markets open at a higher price than the previous day close, as you can see, leaving a gap on the chart. This type of gap indicates strong buying interest and often signals the start of an upward momentum. A bullish gap are commonly seen during positive market development or events that boost investors' confidence. This is a typical example of what I was explaining. This is a gap in price. The next candle in the next day opened at a price higher than the close of the previous day in a bullish gap. Conversely, the same goes to a bearish gap when price opens at a lower price than the previous close, creating a downward gap. This pattern reflects strong selling pressure and often indicates the beginning of a downward trend. Bearish gap typically occur during negative news events or when traders are exiting position due to fear or uncertainty, as seen in this example. This is an example of a bearish gap. Now let's dive into how we can take advantage of the strategy, how we can trade this strategy, how we can capitalize on them. And we have certain entry rules in case we want to take advantage of this strategy. The bullish gap, we have to first wait for the first 15 minutes candle after the gap has been formed to confirm the direction. We ensure that the higher time frame aligns with the bullish trend, entering a long position if the price continues to rise after the gap, in the sense of after this gap the next 15 minutes candle needs to show us that price wants to rise. That means the candle has to be a bullish candle, giving us signals that price wants to rise. The same goes for a bearish gap. We have to wait for the first 15 minutes candle to close after the gap has formed to confirm the downward direction. We have to also check the higher time frame that to see if it supports the bearish trend. Then we enter a short position if the price continues to fall. Now, going from the bullish example, first of all, we would have to check the trend of the market. we'll check the trend of the market from the higher time frame. We'll mark this area here. We'll go to the 15 minutes or the 1 hour at the higher time frame to see the trend of the market. As we can see, this market is trending to the upside. As we can see, the area we marked, price is actually trending towards the upside, so we are in line with the direction of the market. Excuse me. Now let's see how we can enter this particular trade. Let's see where we will set our stop loss and where we will set our take profit to maximize our profit. After we identify the gap in the market, we need to bring out our long tool and take it. Remember, we have to first confirm the first 15 minutes candle has closed after the gap. Then we'll put our entry at the open of the candle of the next 15 minutes candle. Then we can put our stop loss at certain places. We can put our stop loss first just below the gap. We can put our stop loss just below the gap. Let's make this larger so that everybody can see it. We put the stop loss just below the gap. Secondly, we can also put our stop loss just below the candle that has formed. You can put it below the previous 15 minutes candle. But to have enough room and to give your trade enough room to breathe, you just put it just below the gap. Then our profit target, we should aim for previous swing structures, or we can aim for support and resistance area. This area was previously a resistance area. As you can see, a lot of resistance was going on in this area of the market. So we can aim for areas like this, which gives us 1:4. But if you want to be conservative, we can just aim for 1:2 or 1:3, as the case may be. The same goes for the bearish trade. When we want to enter a bearish position, after we wait for the first 15 minutes after the gap to close, we enter our position. We put the stop loss above the candle or slightly above the gap, inside the gap, above the gap. Just put our stop loss around that area to give the trade enough room to breathe. Then our profit target, we can target previous swing lows or swing highs. As you can see here, this is a previous low. This is a previous support area. It can be called a resistance area, but right now it's a support area. It is a previous swing low, so we can use that as our first profit target, or we can just target 1:2 or 1:3, as the case may be, to be on the safer side. As you can see, this trading strategy is a very easy one, and is something that any trader can be able to add it to his trading arsenal. Now, the final take profit area we can still use can be psychological levels. We can use psychological levels or psychological number, which are also called round numbers. We can use round numbers that ends with 00 or 50. We can use such numbers as take profit target. As you can see, let's look for the number that ends with 00. Look for numbers that ends with 00. This can be a very good profit target area. It will still give you enough profit. 1:2 is a very fantastic trade. You are risking 1% of your account and you are gaining 2%. 1:2, or you can target 1:3. If you risk 1% of your account, you are gaining 3%. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Don't forget to turn on the notification bell so that you wouldn't miss out on any of our trading tips and strategy. Thank you for watching, and I will see you in the next video.